This is the Daily Market Rundown live from the Tradelo trading floor. It's April the 29th. Some highlights from today's show. The US reveals the tariff escalation playbook. The DAX is of course the star outperformer. And Meta and Microsoft are now in focus. Good day traders, and welcome to a action-packed week ahead. Let's get straight into it. Some of the overnight moves. It's a relative calm again in the European session, but of course that's what we're expecting as we move into the latter half of this week, where we're going to see the first bit of hard data start to hit the markets. Of course, starting today with jolts. We'll go over that in a moment, as well as we'll talk about some of the key earnings out later on from Microsoft and Meta. But with that in mind, let's get across and turn to our first topic of today, which is all about, of course, the fact that the US has now revealed to us ultimately what their playbook is going to be in the ongoing tariff situation with China. Now, it's very, very important. This is actually out on Bloomberg today. It wasn't in the Reuters terminal, but it's actually come from Bloomberg, and it's all about effectively what Besant was leaning on yesterday, which is this idea that, look, they're going to give China an opportunity to come and pick up the phone, to strike a deal. We know that China said they will not accept any talks until the point that the US removes those tariffs that were put in place effectively on Liberation Day. And so we're at a stalemate scenario. We've been talking about this for the last couple of sessions. And just yesterday, Scott Bessent comes out and he says, look, either you come to the table or we recognize that you are very fearful of having tariffs on certain goods. And if you're not going to come to the table, we're effectively just going to embargo those goods. And this is almost an identical playbook to what we saw, a couple of weeks ago, where the US administration tested the water with a 90-day extension. It was a supposed fake tweet. They put it in the market, and then just a couple of days later, we actually got the 90-day extension headline. This is identical. It's Scott Bessent really testing the water. He's telling the Chinese exactly what he's going to do if they don't come to the table. Now, what that means is I suspect we've got a limited time frame. I expect that we should hear something about this over the course of the next couple of sessions. Of course, he does want the Chinese to mull over this idea of embargoing certain goods, of course, leases on planes, of course, medical equipment, and some semiconductors. So he knows this is where the Chinese are sensitive. He knows that ultimately by posing this threat to the Chinese, he can hope that they will come to the table. But like I said, the Chinese have dug in their heels, so it's now a question of when, not if. Okay, the next phase of this tariff situation is going to be escalation, not de-escalation. And it's important to talk a little bit about this because structurally, when we look at the charts, there are certain markets you want to be trading and certain markets you want to be avoiding. Now, if you look at some of the charts here, what we've got is what we call a rebasing index. All it's doing is it's taking key macro markets and putting them up against each other on a percentage level. Okay, and the way to think of this is we're looking at Liberation Day, which came in effectively around the 2nd and the 3rd of this month, and the star performer, the best performing market all month, is German bunds. Okay, we can see German bunds are up 6.5% over the course of this month. If we go and compare that to the US bonds in purple, we can see that they are flat on the month. Okay, so there was a significant risk off that. All the flow went into German bunds, and as a result of that, of course, we also know flows went into the euro. Okay, so money came out of the dollar, went into German bonds, and didn't go into the typical safe haven like 10-year US bonds. Okay, if we go and look at the equity space, we can see that the S&P 500 currently is down 1.8% on the month. If we compare that, of course, to the DAX, we can see it's mostly flat on the month. Okay, so all risk markets got hit, but we can see, of course, the US markets got hit quite a lot harder. And if we go and then look a little bit further down the page, we can see the Russell is down even further by 2.3%. Okay, so it was very much a case of the most sensitive US indices was, of course, the Russell, the economy stocks effectively, and then the S&P 500. So very, very important if you're going to trade the US indices, you're going to get more bang for buck, of course, trading the Russell versus the S&P. And then, of course, in terms of trading the DAX, sure, it will go down, but again, it's going to be sticky on the downside. Okay, we'll talk a little bit about the DAX chart in a minute because it is a significant market to be paying close attention to. Okay, and then, of course, if we go look at the likes of gold, we can see that gold is up 8% this month. I don't have it currently on the chart. And one of the key markets to the downside to trade, of course, has been both the dollar, which we can see is down minus 4.8%, as well as oil. Okay, oil was very, very sensitive to the escalation. So, you know, if we're going to summarize it, your best markets to hit to the downside are going to be the likes of oil first and the dollar as well at the same time. To the upside, we want to be long of gold, long of German bunds. That's the playbook now, is short oil, short dollar, long gold, long German bonds. That's where you're going to get your best bang for buck. Sure, US equities will sell off, but it's all about where you're going to get the maximum gain when that escalation starts to happen, which I suspect is later on this week. Okay. Now, with that in mind, that is the S&P 500 chart, and I mentioned earlier that this is actually really a good time for a trader's perspective to have an escalation environment again. Why? Well, because we've had that very significant bounce now. We can see we're only effectively 2.5% lower from the Liberation Day close effectively. And so right now the markets are very well positioned ultimately to stage a very nice hard offer. There's a lot of space to the downside relative to how much more they can move to the upside. Okay, so from a risk reward perspective, right now would be a good time to get an escalation, because not only is the VIX really kind of compressing itself, but we are at those sort of price levels where we can very quickly make our way back down to that 4,800 level. Okay, now with that in mind, of course, there is the DAX charts. I'm just going to scroll between the two of them. You can see how the S&P has staged somewhat of a V bottom, but if we look at the DAX, I mean, it's a picture perfect V. Okay, it's a market that is shaping itself to move all the way back up towards that 2,300, which is effectively the Jan, Feb, March VPOC, or volume point of control. It is a price I expect we'll get to relatively easily if we weren't to get any commentary from the tariff side over the next couple of days. But DAX is the star outperformer. It is the market that is going to keep outperforming this year. Why? Well, because the government's just told us they're going to spend a heck of a lot of money. They're going to effectively just go in and spend. And that is very much why the DAX is not just the outperformer over the last month, but of course will continue to be outperformer over the course of the year. So pay close attention to the DAX. I do expect that gap is going to get filled in short order over the course of the next couple of sessions. Until then, it's not a market you want to be short of. It is a market that I suspect will sustain this bid so long as we don't get a re-escalation. Now, our next topic of today is very much one that's a little bit left field. It's not something I've read much about it yet, but the general thinking with this tariff situation is that they'll prove to be inflationary, and that is true to a degree, and I think it's true depending on what country you're in. Now, if you're in the US, fine, you are the one importing effectively via higher tariffs, which means you are going to have some degree of tick up in inflation, and of course there will be some demand destruction from higher prices, but the general thinking, the general consensus from the likes of the Fed and central banks is that tariffs will prove to be somewhat inflationary in the near term. Okay, that's the consensus thinking. However, I'll push back against that and say what I suspect happens as a sort of a next phase, or the thing economists will start to be talking about, is effectively the dumping of China goods. Now, keep in mind, China has, of course, been producing a significant amount of goods over the course of the last couple of months leading up to this tariff situation. So they are sitting on a lot of goods, okay? Now, those goods have to go somewhere. Now, yes, it's all good and well saying, well, no, Chinese will just keep them and, you know, they'll keep it and sell it to a domestic market that's currently in a recession. But in reality, those goods are going to find a home somewhere. Now, it could be Africa. It could be a number of different countries. I suspect one of the key countries, one of the biggest other consumers other than the US, is Europe. Okay, so what this means effectively is if China's going to start dumping a lot of goods into Europe, fine, yes, we've got regulation in Europe. We do have dumping measures in place. And of course, European Union officials will be very alert to this dumping issue. But the reality is I think we are going to import a lot of deflation from this. In other words, we're going to get a lot of cheap goods coming into Europe. And effectively, the result of that will be not inflation going up, So not inflationary, but if anything, slightly deflationary. Okay, keep in mind as well, we have seen the euro appreciate 10% this year, which means we are importing even further inflation from the rest of the world. No, sorry, it's deflation from the rest of the world. Okay, the point is I think the ECB is in a little bit of a bind here, where not only are we not going to see inflation coming from these tariffs, but I suspect we're going to start to see somewhat of a deflationary environment. And the best place to see this will be the break-evens. Okay. Now, what we've been talking about over the course of the last couple of months is that those break-evens have been sitting very close to 2%. We know the ECB is very much confirming victory on the inflation front, and we are starting to see a lot more officials piping up in recent days talking about this idea of, look, we just need to keep our foot down. We need to obviously be data dependent, but it does look like we have got further room to cut interest rates. Okay, now I want to just point your attention back to 2014. Why? Because we saw a very similar setup. If you go and look at this little section here, for a good 6 months at the start of 2014, everything seemed fine. Everything seemed good, as if there was no problem within the European Union. But what then resulted was we started to see a little bit of a sell-off around that 2% and stabilization, and then a continuation. Okay. Now it was at this point where I've got this vertical line drawn, where Mario Draghi came out effectively referencing five-year break-evens as becoming, sort of no longer anchored, and that the ECB would need to act. Okay. Of course, they then began a very aggressive policy, a mix of QE as well as LTROs, as well as cutting interest rates into negative territory. Okay, the point is that yes, right now inflation expectations are firmly anchored, but they are firmly anchored at a very, very low level at a time when we're about to import a lot of deflation, not just from dumping goods from China, but as well from a much stronger euro. Okay, the point is keep a very close eye on these break-evens. At some point they are going to matter. At some point they are going to force the ECB into a not necessarily a more aggressive cutting cycle, but perhaps a continuation of the existing cutting cycle, as well as perhaps relaunching some of their programs to really boost spending and of course ensure we don't de-anchor in terms of inflation expectations. Okay, keep a close eye on that, because I think that is something that's going to become a story from economists over the coming months. Now, with that in mind, we do have two very important companies reporting tonight. It's in the form of Microsoft and Meta. Both of them matter simply because we want to know about CapEx. Okay, we of course have this confirmation right now that CapEx for 2025 is going to be ongoing. And I don't think 2025 CapEx matters a great deal. Of course, if either one of these came out tonight and said, look, we're reducing CapEx spend for 2025, that's the end game. That is the AI bubble effectively bursting. We will see a significant risk off as a result of that admission. Right now, the general thinking is no, there's no slowdown to the expansion of the supply of data centers, but like I said, this is an unlikely event. It's not expected. If it happens, yes, you will get some significant risk off. Okay. Now, with that in mind, like I said, it's not so much about 2025. It's very much about 2026. They are at some point, both these companies, going to have to give us guidance on 2026. I don't think we get it tonight. Why? Well, because right now, I'm pretty sure most of these CEOs want to get in there, give some form of an update and get the heck out and not say a great deal. Why? Because we are in an extremely uncertain environment. Okay. The point is that we have to be there, switched on for it, just in case. Do we get something? Probabilistically, no, but we do want to be switched on for what are those market-moving things. Okay. Now, with that in mind, both Microsoft and Meta, and I just want to show you these charts. We can see they're both sitting well below those 200-day moving averages. Okay, we've been referencing those as very important markers for not just the tech industry, but the indices as well. Because if we're going to fail to break up above those, it is going to confirm that we are now in somewhat of a cyclical downturn, and ultimately we have seen sort of the Mag 7 leadership falter, and it's no longer going to provide support to the markets. Okay, so keep a close eye on that. I wouldn't be surprised if we did what, for whatever reason, blip up there today in either of them. Don't be surprised to see the market entertaining shorts at 580 in Meta, and of course at 414 in Microsoft. Okay, and then finally we get the first bit of hard data. I cannot stress how important this data point is today. We do have a number of data points coming from the US today, but it's the first time we're going to get hard data from effectively or since Liberation Day. In other words, if we are going to see some sudden slowdown, if we're going to see some, sort of investors, not investors, companies really showing some concern over the recent tariffs, this is the first place you're going to see it. Okay, JOLTS is, of course, private hiring. And so private companies typically are a lot more nimble. They can move a lot more quicker in terms of removing job postings. Okay, that's all the JOLTS is how many jobs are available within the private sector. Okay, now what we can see and what we know to be true over the course of the last 2 years is that we've been in this downtrend. Okay, so that's not new information. What will create some degree of concern is if we get a significant drop today, a significant miss. Now, what is a significant miss? Well, expectations are for a 7.5 million, so pretty much flat or bang in line with where we were last month. Okay, what a big miss will look like is if we get a 7.1 or below. Anything below 7.1 million, effectively what the market does is it thinks 2 steps ahead, which is, hang on a sec, we got 7.1 million, so a much bigger drop off than expected. And if we got that 3 weeks after Liberation Day, guess what we're going to get next month? Something even bigger, something perhaps down to 6.5 million. Okay, because as companies effectively remove jobs, it's this sort of spiraling effect. If we have 400,000 less jobs available this month, we're probably going to have a lot less jobs available next month. Okay, so markets will put one foot in front of the other. They will make a lot of assumptions as to we're seeing quite a significant slowdown or a much faster slowdown than what was expected. Okay, now again, this is me all just creating a hypothesis. Okay, probability-wise, median expectation-wise, we're probably going to get a number in line. But it's very much being switched on what is the hard piece of data that the market's going to respond to and what is the market going to be sensitive to. Okay, anything below 7.1 million, you are going to get some panic. And remember what I said, where is the opportunity scope? Well, it's long gold, it's short equities, it's long German bunds, it's short oil. Okay, just like that rebasing chart I showed you, that is ultimately what you lean on now, because when that risk-off comes back to the market, that's where the opportunity scope is. Okay. With that in mind, of course, it is a big week ahead. There's a lot going on. It's JOLTS today. We've got earnings out tonight. We then move on to the Q1 GDP read tomorrow, which, whilst it is a lagging data point, it is going to be very closely watched to get some idea of ultimately what the situation is in terms of growth. We then, of course, do move on to month end tomorrow as well. And then, of course, Friday, we've got the real big one of the week, which is non-farm payrolls. Now, we'll talk a little bit about why that matters tomorrow. I think non-farm payrolls for the first time does present a significant risk-reward play that I suspect you actually have to be putting on tomorrow once we get through that month end. It is a trade I'll talk about a bit about in tomorrow's rundown, so do make sure you join us live. If there are any other questions, do post them in the Discord channels. Otherwise, good luck out there. Manage that risk. Go make some money.